Well, tech companies have lost more than $1 trillion in value in the last 3 trading days. So what does this volatility in the markets mean for you?
We are answering your money questions with financial expert Terry Savage. Terry, good morning.
Good morning. It's a good morning, too. The market's up nearly 300 points right now, so a bit of a rebound.
Yeah, just saw that. So you say a rebound, but it's been down so much. Should we be nervous?
Yeah, I think everybody should be a little nervous. Let's just talk about the fact the stock market is not just about people who have 401k plans or IRAs and have to make decisions. It impacts a lot of people. The Wall Street Journal was out with a report today that public employee pensions funds are down about 4% as a median for the first quarter of the year. So in the background and emotionally as well as financially, when we hear news about the stock market taking a big dive or a big bounce back, it kind of impacts our psyches. But for people who literally have their fingers on, this is my 401k plan, my IRA, oh, I was making so much money in anything from Bitcoin to, meme stocks. Now, all of a sudden, it's like, oh, whoops, where did my money go? So that can be very emotionally upsetting as well as financially.
So are we looking at maybe a shorter recession at the end of the year or something more concerning?
Larry, it's very interesting. First of all, I've been through a lot of bear markets. If you look back over the last 50 years, there have been 4 that have been down as much as 50% thereabouts. And every single time the markets come back higher, we're higher now than we were when those bear markets ended, of course, and we'll probably be in the long run much higher. But the question is, how long is the long run? And so you've said this before. First, you have to figure out who you are. You're working, you're 43, 47, 52, and you're putting a couple $100 each month in that 401k plan. Your long run is a very long run, and you should just try to not worry about the markets right now. If you're a speculator, I'm not talking to you. You're in and out. You've playing this game, and it's a dangerous one. But there's a whole group out there that of baby boomers now that are just close to retirement or maybe in retirement who've got their 401k plans still loaded up with stock funds or with target date funds, which have performed terribly this year, the ones that are designed for retirees. And so those are people who have to decide how much pain can I take and how long can I take it, to answer your question. Mm-hmm. And what self-discipline do I have if I tell myself now I can stick it out to really do that in case, and it will, I think, the market goes lower. So you asked me, will it bounce back? In the last 15, 20 years, we have been conditioned to think, well, it'll bounce back. So that always in the past meant I'll buy it on the dips. Now we're starting to see a lot of people say, well, when it bounces back, I'll sell it on the bounce. And that's not a healthy thing for the market in terms of pressure to go upward. So I think this kind of, maybe not the horrible numbers that we saw with 1,000 points down, but I think this could last a lot longer because of the underlying economic forces. And so a year, 2 years, 3 years, in the 70s, the bear market lasted. It wasn't a bear market the whole time. It just went down and stayed down for a decade. I don't think that will happen, but it could be longer.
We may have time for one question. I'm going to skip ahead because I think you answered one of the viewers' questions. I'm going to skip ahead to this one. I have heard a lot about I-bonds. Should I get involved with those?
Well, that's only one great place you can hide today. I-bonds are now paying 9.62%. You heard me mention them last fall when they first jumped over 7%. There, if you go to terrysavage.com, there's a column right on the top, how to buy I-bonds. You don't go to your bank anymore. You go to treasurydirect.gov. You can only buy, if you have that kind of money, $10,000 worth a year. You must hold them a year, plan to hold them 5 years. And I don't think we'll see those eye-popping numbers again because we're doing year-over-year comparisons for this inflation adjustment. But just a quick word about inflation. I-bonds are the one place you can kind of beat inflation. It's a unique kind of a situation. But inflation is now being built into our society. It's not just the stock market that's reacting to it. This morning, they said gasoline prices are at an all-time high, nationally at $4.37 a gallon. So we can expect inflation to last a lot longer. And it hits, unfortunately, the people maybe who are not worried about the stock market, but are worried about grocery bills. All of that hits the economy somewhat. And that's why I go back to the stock market thing. If you're a retiree and you know you're going to need to take money out every year to live on, you might want to find a place to hide, like a stable value fund or a money market fund inside your 401k, so that you have the cash to withdraw, so you're not forced to sell when the market's down because you need withdrawals.
All right, Terry Savage, thank you so much for joining us. Of course, you can ask Terry a question at terrysavage.com. Thanks, Terry.
Thanks, Terry.
Thank you.
Time now for On Time.
Hey, Anna.